In our previous video, we learned about vertical analysis and horizontal analysis. Now let's move to ratio analysis. It is a quantitative approach to understanding a company, breaking down its financial statements to uncover insights from multiple angles, like profitability, quality of earnings, liquidity, solvency, efficiency, and how the market values it. The first angle we'll look at is profitability, which answers the question, is the company making money? These are ratios that show how well a company generates profits. It looks into margins, earnings, and returns. Margins show how much profit the company keeps at different stages of the business, from sales to operations to final net income. Let's compute. Formula for gross profit margin is gross margin divided by net sales, which makes our sample company's GPM in 2024 18%. If we add horizontal analysis into this, we will see that its 2023 GPM is 17.8%, telling us there was improvement in 2024. But is an 18% gross margin good or bad? To make a good judgment, we must compare it to its industry. If we look at its peers' 2024 GPM, it is at 24.2%, higher than the company. Through comparison, we can see if our company is at par with its industry, or if it's doing better than its peers or not. Let's move to operating profit margin. The formula is operating profit divided by net sales. At this stage, the company is able to keep 6.9% of its sales after operating expenses, compared to its peer at 4.9%, which means our company is doing better. The last margin is net profit margin. This is computed by dividing net income to net sales. This tells us that out of the company's 219 billion net sales, it was able to keep 4.8% for itself. In comparison, its peer was able to keep 5.2%. At this stage, the peer has a better margin. Now let's talk about earnings per share. The formula for EPS is net income minus preferred dividends, divided by its weighted average outstanding shares. EPS is a standard inclusion in the financial statements, so let's just talk about what it implies. This is the profit that the investor earns from the business for every share held, and we always want this amount to grow every year. EPS is very important in the stock market, but we'll talk more about this when we dive into valuation. So let's move on to returns. This shows how efficiently the company uses its assets and equity to generate profit. Here's a cheat sheet of what is generally considered as good returns or bad returns. For return on assets, below 5% is ineffective utilization of assets. 5 to 20% is generally good, while a 20% ROA is an exceptional return. For return on equity, below 10% is ineffective utilization of equity. 10 to 20% is generally good, while above 20% is an excellent ROE. But here's a warning. This is a rule of thumb. It is more important to check against the industry to assess the company's relative performance. Let's compute. The formula for return on assets is net income divided by average total assets, which is the simple average between the current year's total assets and the previous year's total assets. Our sample company's 2024 ROA is 5.8%, at par with the general benchmark, so this is good. But its peer's ROA is 6.3%, so by comparison, the peer has better asset returns. The formula for return on equity is net income divided by average shareholders' equity. This brings the company's ROE to 11.3%, still good by general benchmark, but its peer's ROE is at 12.6%. So in comparison, the peer, again, has better returns. So what's our judgment in terms of profitability? Is our sample company profitable? It is, but is our sample company better? Based on what we've seen, it appears that it was better in 2023, but its peer outperformed it in 2024. Here's what you should remember for profitability measurements. The higher the number, the better. You can refer to general benchmarks to form a judgment, but it is best practice to compare it to its industry to see if it is leading or lagging or just average. Keep in mind when comparing within its industry, the leading isn't automatically the best choice. You also need to compare the company to its own past, looking for stable growth instead of one-time spikes. The next angle we're going to look at is quality of earnings, which answers the question, is profit backed by real cash? Let's look into cash flow from operations to net income ratio. The formula is in its name. Divide cash flow from operations by net income. Our sample company has 1.6 times CFO to net income ratio, while its peer is 1.2 times. What does this mean? A ratio of 1 is already good, which means that profits are backed by cash. For every peso reported as income, the company collects 1 peso from it. If the ratio is less than 1, this could signal weak cash from operations, while a ratio above 1.5 times tells us the company has strong operating cash flow. Thus, their earnings are high quality. But again, it is always best practice to compare ratios within the industry. So back to the question, is the company's profit backed by cash? Yes, it is. Are its earnings of better quality than its peer? Yes, it is. But keep in mind when making comparisons, the non-leaders does not automatically mean losers, because in our example, the peer has good quality earnings too. This ratio is powerful because earnings can be affected by the management's accounting choices, but cash is harder to manipulate in the books. By adding cash flow into our analysis, we are also adding another layer of credibility to earnings. This helps us watch for red flags, like when the company's ratio is consistently below 1 times. So far, we've looked at how profitable a company is and whether those profits are real. But profit alone doesn't tell the full story. Can the company pay its bills? Can it survive long-term debt? Is it running efficiently? We'll cover all of that in the next video, where we break down liquidity, solvency, and efficiency ratios. Please keep in mind that the companies used in this video are for illustration purposes only. This is not an investing advice. Thank you for watching. If you liked this video, please like or subscribe to my page and channel. See you on the next one.